Hi, this is Dave with Market Trading Concepts. It's May the 27th. This is part two of the video that I'm producing today. The first part focused on stock index futures and the stock indexes in general. So this part two will focus on all the other markets, currencies, bonds and notes, currencies, metals, grains. So let's jump into part two here. Let's start with the 5-year. Let's see here. So let's start with the weekly chart. Now the weekly chart had a Darvish squeeze fire. Had a Darvish squeeze fire 2 weeks ago, and you can see we closed out the week really tight. Doji on the week here. This kind of action here is, a little bit of indecision here, but everything's looking fairly strong to the long side on the weekly chart. You don't really have any real follow through of the breakout here yet, but you do have, you're 4 weeks into the squeeze. The MACD looks like it wants to roll higher, but you've got a little bit of divergence here with the hitting new highs, and the momentum of the trending indicator of my trending indicator is pointing lower. That makes me a little bit cautious. It's a little bit divergy, if I can use that as a word. I don't really like divergences. I like to see kind of everything in alignment. So I personally believe the bonds are in a bubble, and I think interest rates, that's just my personal opinion. I think interest rates need to go lower, but at this point in time, I wouldn't fight it, and I would look for valid sell signals before I look to, to want to short any market for that matter, but this one in particular, because the market has been very, very strong. So let's have a look at expand out the daily chart of the 5-year, and what you can see here is you've got a little bit of cross action happening where the weekly chart there, you can see that we just looked at the weekly chart fired a Darvish squeeze long, while the daily chart just fired a Darvish squeeze short. So you've got some cross currents, to say the least, and I personally, at this point in time, would probably stay away from these markets entirely from a swing trading basis, because on the one hand, the weekly looks great. You've got a great valid weekly signal, but what you have here is you have a situation on the daily chart where you're at support here, but you keep knocking on support's door here at the 21 EMA. You fired a short signal with a target down here of 123. Roughly 123. Okay, so now you've got red Hakanashis, you're in a squeeze. You've got a little bit of a pickup in volume here. The MACD is rolling over, but it's above the zero line, and your trending indicators net positive. So you've got a bit of conflict going on here, and what you really need to see is how that's going to resolve itself. It's not uncommon for, even if the weekly chart stays intact, for the daily chart to have a pullback down here into the support level here. So this looks like fairly strong support here, right in and around where the target is. So that wouldn't, a pullback down to that level would not negate really the strength of the weekly chart, but it is a potential for a pullback. Now you can see we have some fib numbers in here and some targets from previous signals that fired and failed, but we had this. Let me explain this properly here. Well, I'm a little bit all over the place because it's Sunday and I just got back from being a week away from the markets, and still not in the zone yet, so I'm just trying to get back into things. But you can see here, we had this sort of cut pattern form, and you can see when we had a Darvish squeeze breakout of this, the target would have been up there. But when I see like this kind of pattern form here and you break above the highs, then you can start looking at fib extensions, right? So you have this 1272 extension and potentially this 1618 extension, which is the breakout. It's an extension from this high to this low that we just have kind of left on the chart. So what you're looking at is, from the high to the low, the extension upwards. You've already hit the 1272 extension, right? You didn't quite hit the 1618 extension. Okay, so the 1618 extension is still way up here around 124, 124.25 it looks like. So what I'd be expecting to happen here is either a continuation or a pullback. I mean, either one of them could happen. That sounds a little bit non-committal, and the reason why is because it is. You've got some divergence on the weekly chart, but you've got overall strength, and then you've got a fairly valid signal on the daily chart, but it's against the trend. Okay, but the thing that's kind of giving me a heads up, besides the divergence on the weekly chart, is you can sort of see here here's a high, right? And then this to me is starting to look like a lower high. So here you've got a swing high, which is, technically a higher high. And this is starting to look to me like, if it breaks below these lows, this is starting to look to me like a lower high. So I think the safe way to trade this, if you wanted to, sort of counter trend trade it, and trade this Darvis squeeze short, which is essentially, this is a counter trend trade at this point in time because it's against the daily trend, it's against the weekly trend. But I personally feel as though the bonds are a little bit overdone. So I probably wouldn't be afraid to I wouldn't be afraid, or as we say here in the trading floor with the guys, I'm no scared. I'd not be scared to trade the bond short below this level. So if we broke this kind of support here and we came down, let's say, and we broke below there, I wouldn't be afraid to trade the air right in around here to the short side down to this target where you've got support coming in. Now a move, this is basically, I guess the way I would treat this is the dead zone. We'll call it the DZ, the dead zone. So this area right now is the dead zone. If we broke below here, I wouldn't be afraid to trade it short. But if we break above, these, the high of these bars in here, the high of those bars, and we broke above that, I think you'd have to look for a continuation to the long side. So this is kind of like a box you could trade because you do have a counter trend signal. I wouldn't be afraid to trade it to the downside, but the failure of this signal is a signal in itself, and I think that this signal would really fail if we broke above here. So the cautious way to trade it, long above here, short below there. That's really how I'm kind of looking at the 5-year at this point in time. Long above there, short below there. So that's its own kind of dead zone, and you could treat it as a Darvis box kind of setup. So I hope that makes sense. Okay, let's take a look at the 10-year. The weekly Darvis squeeze had fired a number of weeks back, and you can see the target here was essentially met at 134. Was that say 134.21, roughly in there. I have a hard time reading the denominations for the notes and the bonds. Just because I'm not used to, I don't really trade them from the futures perspective. If I see a good setup in there and I want to swing trade it, I will use different instruments, to swing trade these kinds of setups. But I don't specifically trade the notes and the bond futures. Okay, so but what I'm looking at here is from a chart pattern perspective. A chart is a chart. You had a long signal with the long was at 132. The text should actually be down here. The long was basically here, and it basically met its target. So the long setup is still intact, but it's not unusual once it's met its target to to get a pullback from there. So that kind of you still got those cross currents, but I wouldn't be surprised to see a pullback. Let's just say that I wouldn't be surprised at this point in time to see a pullback, even on the 10-year. If we look at the daily chart of the 10-year, you can see we had these fib extensions drawn on here from this high to this low. Okay, so if you look at it from that perspective too, here was your high in and around this area. Here was your low in and around this area. So from the high to the low, you hit the 1272 extension, okay, and then you hit the 1618 extension here, and you can see the 1618, which is, you know, this is kind of the easy target, and this is kind of, you know, the harder target. Well, you hit the, you know, the 1618, you hit the harder target, and you can see it's providing resistance here. I wouldn't expect it to just blow through there. So I wouldn't be surprised, you know, looking at it from all these different perspectives, I wouldn't be surprised to see some sort of a pullback at this point in time. I wouldn't want to get long up in here. If I wanted to get long, I'd be looking at, you know, getting long on a decent pullback. Or maybe even taking a short-term counter trend short, but on the 5-year, because you don't have a valid signal here. You don't really have a valid signal on the 10-year, but I do think that these markets are a little bit overdone. So I do think they're a little bit overdone in the short term. It's not to say that they won't go higher, but I think it makes sense to, at least in the near term, to see some sort of a pullback first if they're going to resume higher. To at least see some kind of a pullback first. Okay, and let's round it out with the 30-year. So I'm going to expand out the weekly chart. Here you have a valid Darvis squeeze signal on the weekly chart of the 30 with a target much higher, you know, at this 157 and change level. But you were kind of, let's see, we closed kind of doji on the week, right? We closed kind of doji on the week. Everything's still intact here for the long side. Actually, the 30-year looks the strongest, except for this this kind of divergence here, which I don't really like. I don't really like that, where we're going higher and then the momentum on my trending indicator is going lower. I still think these markets are overdone, but that's not to say they won't go higher. So on the 30-year, I really don't have any... you know, I mean, this is just really looking long on the weekly chart. And even if you did have a pullback, the net bias is still long side. So at this point in time, I wouldn't want to be short the 30-year at least, even though I'd, you know, probably take a crack at maybe the 5-year if it followed through, as we discussed, you know, a little bit earlier. The daily chart, if I expand out the daily chart, you know, it just, the only thing that I can really comment on, personally, I'd probably stay away from these markets entirely, but, you know, barring the fact that I might take a short-term short on the 5-year if that Darvis squeeze on the daily chart follows through. What I'm looking at here is the non, how do I word this properly? Okay, I just had to pause the video there because I had, you know, pardon my language, but I had a bit of a brain fart there, where I wasn't really coming up with the words that I was looking for to describe the situation here. The situation is really one where these markets are a little bit tricky, in my opinion, because you have some. I guess I have in the back of my mind, I do have a bias that these markets are in a bubble and they're overdone. That said, markets can stay irrational a lot longer than we can stay solvent as traders. So what I'm really looking at here is you've got some sort of divergences and you've got some conflicts between some of the signals where you're getting, you know, some short-term short signals, net long biases on the weekly charts. You know, you've got some short-term short signals on some daily charts, and you just, you know, you've got some really, when you hit some major key targets, it's not unusual to see a pullback from there. So you're looking at maybe some short-term weakness as well. So really what I'm looking at is some conflict between some of the signals, and I think a pullback really makes sense for many of these markets. Like you can see here, the MACD looks like it's really, from an oscillator standpoint, close to the top of its range, and it looks like it wants to kind of cross over, but it's against the trend. Now, when I see this kind of happening, what I'm looking at is I don't think it's going to blow through that high. I think it's probably going to come back, and at least at a minimum, retest on the daily chart its 21 period moving average. It hasn't touched it in a while. So even though the markets are net long, I think pullbacks are probably in order, barring some kind of crazy geopolitical event or some kind of crazy, for lack of a better word, government manipulation of the prices, because they want to keep interest rates even lower. You get the money flow in there to push it the way they want it. I think which probably happens quite often. I think that's what we're seeing now. But at this point in time, if I don't have a clear picture, I don't trade it. And unless I really, as the market develops and unfolds, unless I saw something that, which like on the 5-year where it broke that support level and I thought that maybe that Darvis squeeze short would follow through. At this point in time, I think, to make a long story short, I would just leave these markets alone until they make a little bit, more sense. And they're more, there's less conflict and there's more alignment between, what all the different pieces of evidence are really pointing at and what they're really saying. Hope that makes sense. Okay, and let's just take a look at one more perspective here on the 30-year. I'm going to draw some fib extensions on here. Drawing Fibonacci tools, price retracement lines. Okay, let's go from this high. Okay, let's go from this high to this low, and it's easy to use these on Darvis boxes because it kind of denotes exactly where those levels are. So if you look at this, what you can see is here it's kind of showing it to the right, and I'll just kind of drag this over. You can see here where when we broke above this high, the first target was a 1272 extension, which we hit. The second target was a 1618, which we almost hit, but that was really close enough. That was really close enough for the target. We came really close. So at this point in time, I really wouldn't be looking for much upside, at least in the short term, above the 149. If we did kind of spike into the 149, I think that would be, I think that we would probably get a pullback from there. So we're either going to get a pullback at this level or, we might spike into it and then get a pullback. But I'm really not expecting in the short term, at least in the short term, any real major move above those levels at this point in time. Okay, I hope that makes further sense. Okay, I probably should have done this in the other video, but let's take a look at Google. This really should have belonged to the stock index futures, but it looked a little bit interesting, so I thought we could take a look at it. So Google has fired on the daily chart a Darvis squeeze short at 595.99. Okay, so around 596. It looks like it closed out the day around 591.53. So it's let's see, about just over $4 below its sell signal. It has a potential target of $554. So if we're going to see some downside, in the stock indexes, this signal, the follow through of this signal looks like a potentially good trade. So what we're looking at here is we've got red Hakanashis. You've got the Darvis squeeze that fired here, looking good. Volume's a little bit, it's picked up a little bit, I guess, but it's, nothing really to talk about. Now we look like we're about to roll over below the zero line here on the MACD. Okay, so the zero line is providing resistance. Oops. The zero line is providing resistance on the MACD here, and it looks like it wants to roll lower. Okay, my trending indicator is in alignment with what everything else is saying. So this looks like a good potential setup here. Darvis squeeze short on the daily chart of Google. If we're going to get some follow through in the stock indexes, then usually they say 3 out of 4 stocks follow the market. So this looks like a decent potential short trade to look at. Now, in terms of risk reward, or in terms of parameters, what I'd be looking at, and this is just, this is not trade advice. Again, this is just my opinion. I'd probably be looking at a stop above these candlesticks here. Probably above the high of this candlestick here. a stop above there. So that's about 50% the width of this Darvis box, and I'd be looking for first target. I'd be looking at a first target of 1 to 1, so whatever the half the width of this box, and then I'd be looking for a second target down here at 554. So the difference, and I'm sorry, I'm not going to do the math here, but the difference, half the box here, and then the ultimate target being about 5. I get a little bit in front of it, so the ultimate target would be to cover the short when the stock reaches like 555-ish. Okay, I'd get in front of that target a little bit, 555, 556. There's no reason to get greedy there. You want to get in front of it before everyone else really gets out. So that looks like an interesting setup in Google that's shaping up there. So just following up the theme on Google, here's the weekly chart of Google. And what we're looking at here is the bottom of this Darvis box. You've got some support coming in here, right? You've got some support coming in here at the Darvis box and at these lows of around 562. So that's kind of a caution area where if you're short and you're looking for that full target, that you may be looking for some short-term support to come in, and you might want to actually take some profits around that level there at 562. But what you can see here is it may provide an opportunity to actually, if we're going to get some real weakness in the stock market, you've got this weekly Darvis box potentially setting up, this weekly Darvis squeeze where, you can see this coming into play. These are red. You're going to have support at the 0 line here. But if this crosses over to the red side and then we fail this support level here at 562, then it might make sense to either just short below it or look for a retrace back into that breakdown point around 562 to get reshort. So I hope that makes sense. We're looking at really the same perspective but on two different time frames. Now if you're already in the short position and we fail this level and you're willing to hold on, then that might even make more sense. Recognizing though that there is potential longer term support coming in here, and we may not actually fail that support level. So I hope that makes sense. Okay, let's take a quick look at natural gas. I'm going to start with the weekly chart. Some of the guys in the room here, they trade natural gas. They look at natural gas. So I'm just going to take a look at at the natural gas from this perspective. Now, net, I mean, we're in a huge weekly downtrend, right? Here's the weekly chart. We're in a huge weekly downtrend. We did find some support, and we've had 1, 2, 3, 4 weeks of strength. Last week looks like we had some. It looks like we had some weakness last week in the natural gas. So, but for the last 1, 2, 3, 4 weeks before that, we had a retracement. Now, the retracement has been a logical technical retracement, not a fundamental, but a logical technical retracement into this 21 EMA, which is a logical resistance level. So this was really an overdone market. It saw some downside for a long time for an extended period, and you can see now that we had a retracement right back into this this 21 EMA, which is logical resistance. Logical dynamic resistance. So looking at that, it looked like we pulled right into that on strength and then we pulled off of it. Now what you have is a situation where you've got, here's the 8 EMA on the weekly chart. So you're kind of trapped in this, what's sometimes referred to as a kill zone, but it's really like it's a tough area to trade because here's your resistance, right? And then you've got support coming in below the 8 exponential moving average. So you're kind of caught between your 21 and your 8 EMA, and it's really like a what I also call like a dead zone, a no decision zone. What do you really do there? You've also got from this high to this low, and I don't think that's exact, but you've got this 50% retracement area here. Right, so you've got this, you came down, you broke above the 50% retracement, which is showing a sign of strength, and then you closed back down right into this zone. So this is, this is really a tough zone to trade. In order to really want to get short this market at this point in time, I'd really want to see it close below this 253 level in order to get short or to look at the short side. Where you get a decisive close below this 8-period exponential moving average, and you get a decisive close below this 50% retracement. Okay, signaling that you're probably going to resume the downtrend. So at this point in time, though, what you have is, you were really overdone. You're way below your zero line here. You can look from an oscillator standpoint. You were just really overdone in the MACD. You crossed over to the high side, and you've got some blue Hakanashis here. But, if this rotated back to red, I mean, this is a weekly chart, so it would take, it would take a week for this to kind of close. But if, let's say, you got one weekly red bar here, right? And then you got, the MACD it's really overdone. But let's say it tried to cross back below. But really, I'd be looking more at this point in time at the price action to really tell me where it's going. Like a close below this level, 253, a close below the 8 exponential moving average, which is at 251. So 253 to 251, a close below there on a daily chart, decisive close. Would kind of signal to me that maybe this retracement is done. Now, but if it holds, so the flip side to that is if it holds this level, if it holds this area, and it keeps trading above this 265, and then we break the 277 level, which is the 21 exponential moving average on the weekly. So if we stay above 265 and then we break above 277, I don't think you can really look at the short side at that point in time. So in a nutshell, from the weekly perspective, what you really have is a dead zone between, 277 and 252, let's say. So 277, right, and 252. And that's really kind of like, okay, long above 277 and short below 252, kind of treated as a, as a Darvis box type of trade where, you want to trade the expansion of the range on either side. So I hope that makes sense. Now, if I wanted to be long, I'd be looking at this probably 306 from 277. I'd be looking at an initial target around these highs, the swing high, as a initial target. On the downside, I'd probably be looking for a retest of these lows around $1.99 or $2, where the I think you've got some swing low support, some price support, but it's really it's also I think the $2 level is a psychological support level as well. Okay, based on speaking to John in my room who trades it, and just kind of looking at the markets with him. I think that $2 level is probably, if I understand it correctly, probably a psychological support level. It's definitely a price support level at this point in time. So that's really what I'm looking at on the weekly chart. Let's take a look at the daily chart. Let's take a look at the daily chart and see if it's giving us any other information or any other clues. So if I look at the daily chart here and kind of expand it out, it's net. The daily chart I think is net long bias, whereas the weekly chart is more. It's still negative. It takes a long time for that to change. But let's throw a trend line on here. Trend line from these lows, and let's grab a point somewhere in there. Now, if I look at that, this is a little bit. I grabbed it from the first real kind of swing lows. And if I look at that, I mean, you still, from a structure standpoint, okay, from a chart structure standpoint, you still have a series of higher highs coming into play, right? So you've got this higher high, this higher high, this higher high, and then you still have a structure of higher lows coming into play as well, right? Where you have, let's say, this higher low, and then you have this higher low. Now, this last pullback here was a pullback to trendline support, but it was also, it slipped through the trend line a little bit, and it was a pullback down to the 21 EMA on the daily chart. So that is a logical technical pullback. As a technical trader, a pullback to the 21 EMA is normal. So you basically had here, you had the crossover of the 8 and 21, that is a buy signal for some people. You know, you had the first pullback, it didn't quite make it there. Second pullback, I think at this point in time, you know, like I'd be looking at, okay, 1, 2, 3. I'd be looking at, if this level doesn't hold and we close below the 21 EMA, then I'd be looking at maybe a resumption of the downtrend on the weekly chart. But if this level holds and pushes higher, I'd be looking for it to put in a new swing high. So I think that's really how you have to treat this, you know, at this point in time. I'd be looking for, you know, this level to hold until it doesn't. Now, if it pushes above this high, then that would really confirm that you're going to put in a new swing high. And if it doesn't hold this support level and pushes below, then I would probably look, you know, to look at the short side, which would be a continuation of the weekly chart, you know, of the weekly chart. Now, on the daily chart, you've obviously got conflict between the daily chart and the weekly chart. The weekly chart is still weak, but it was just a logical, it was just on the weekly chart, a logical technical retracement back into resistance from an overdone situation. Now on the daily chart, you have a logical pullback to support in the beginnings of an uptrend. So you've got some conflict between the two time frames there, and I think what you really need to see is, that's why I kind of treat this as a Darvis box, because you really need to see, like, this level here is going to coincide with, I think we said 277. This is around 280, right? I think this is around the 280 level. So this is really going to coincide with resistance on the weekly chart, and this is really going to coincide with close to support on the weekly chart too. So what I would do is treat this whole area as a Darvis box and say, okay, you know what? Above here long, below here short. I think that's really, and this the dead zone, okay? And I think that's really, from a swing trading perspective, the safe and logical way to treat it. So I hope that makes a lot of sense, and if it doesn't, feel free to ask away. Okay, let's take a look at crude oil. Start out with the weekly chart. Wow, I mean, crude oil took a beating. I haven't been watching this since I left, but crude oil took a beating. This is pretty crazy. So, but it's taken a beating, but we have some support coming in here on the weekly chart. So what I mean by that is we had a Darvis squeeze short fire. I guess that would be, let's see, this was last week, 1, 2, 3, 4 weeks ago, around this level of, I think this was the major support. I remember there being major support around the $100 to $100.88 a barrel. So it's hard to read this because multiple signals fired and the text is overlapping. But I mean, basically what you have here is you had this signal fire here, the Darvis squeeze fired, and it gave you a target of around $9.80. So this is a level that we had on our chart from the other week. I didn't just draw this level. This level's been there. And it's interesting to see how we hit that level and how that level was actually the target of the Darvis squeeze. You can kind of see how these levels come together. And then you can see that you've got some price support here from these lows, going back in time, these swing highs, this previous support, previous resistance. So this is a fairly key level where all of these kind of levels are coming together, support, resistance, you know what I mean? This is some pretty major support here. So the question is, are we going to hold the $90.80 level, which was the Darvis squeeze target of the weekly signal here? We're looking at the weekly chart. But the thing is it's interesting because you also have, this is really, I think, what I would consider an inflection point. This would be really an inflection point in the crude oil, in my opinion. The reason why I say that is because, first of all, it's a major price support level. It's a Darvis squeeze target level for the short trade. So I would expect there to be some support there. But not only that, you also have the MACD coming into play, where you got some support from a technical indicator perspective at the zero line. But what's interesting to note here is the trend has crossed to the low side. Okay, so from a From a cyclical kind of standpoint on how this oscillator moves, I sometimes look at it from this perspective. You can kind of think of this as kind of like a sine wave, or a cyclical kind of rotation, or for lack of a better word, it really cycles, right? So from a cyclical standpoint, you've got trend up, trend down, trend up. Now we're cycling into trend down. But we're cycling into trend down close to a major support level. So the question in my mind is, you're 3 weeks into a short squeeze here, and this Darvis squeeze has already, target has been met, right? So you've still got some potential downside here. So the question is, this is the inflection point. Are we going to hold $90.80, or are we going to fail the $90.80 level? You've got from a price standpoint, from the previous target standpoint, all the things that I mentioned, some fairly strong support here. But if you get follow through, I think if you get follow through below the $90.80 level, it's kind of like look out below. We're coming all the way down to like $77. So at this point in time, I would not want to be long, and I would not want to be short this market. If I wanted to get short this market, I'd be looking for a substantial pullback into the, this falling resistance somewhere up here in order to get shorted again. Or if it just kind of came back down and it, you got some decisive movement below this level and it came back to retest the breakdown point, I would look at that as a potential opportunity to get short. But at this point in time, I would expect, barring any major events, I haven't been watching the news at all, so I don't really know what's going on from that perspective. From a technical perspective, I'd expect a bounce off of this level, at least a modest bounce. But if we just kind of fail that level there, then I think there's nothing that you can really do but look at the short side down to, this level here. It'll be a little bit tricky from an entry perspective. It's always safer to get the the first retracement back into logical resistance in order to take a position here. But you can't deny if it breaks through there that it just might be something that you have to go with, and and look at some targets here. Now, usually when you get, especially on a weekly chart, where you get this 1-to-1 Darvis squeeze has already been met, you should expect some kind of a retracement. But in extreme markets, you can get twice the width of the box as a target met. So I'm cognizant of that. I recognize that if this market continues to be weak and we get some, you drill down to lower time frames and you get some signals telling you that it is going lower, then this would be a target I'd be looking at around $77. Just maybe $78 just to get a little bit in front of it. I know the $80 a barrel is a pretty key level as well. This is more of an extreme level here. But $77 to $80, I think to the downside, if we don't see a retracement in the crude oil is possible. So I wish that we would see some kind of relief in gasoline at the pumps, considering what crude oil is doing. But apparently if crude oil goes down, gas stays the same. And if crude oil goes up, gas goes up substantially. So ask me how that works and I'll tell you I don't know. So it's kind of ridiculous, right? So anyways, that's kind of how I'm looking at the weekly chart of crude oil. Let's take a look at the daily chart and see if that's giving us any more information. The daily chart here is net negative. We had a Darvis squeeze fire way back here where the target was already met. Way back there, we're over twice that target. This was a pretty narrow Darvis box, mind you, right? This was a pretty, narrow Darvis box. I think we actually went 2.5 to 3 times that target. But if you look at this is pretty overdone. I mean, even the MACD is overdone. It is OD, not overdosed, but overdone. And I think what I would really want to see here, if you look at it from the daily perspective, here you haven't really tested the 21 EMA in a while. And I think the first logical test of the 21 EMA resistance which if it coincided with this Darvis box would probably be a decent level to look at initially, taking some shorts. So what that might end up looking like is coming up to this zero line on the MACD and, looking for resistance from an indicator perspective, looking for resistance from a price perspective, and seeing, you might even want to wait and see if it even kind of probes above it and then comes back and then rolls back over, and then looking at like maybe a 60-minute chart for short signals here, because you could get some extreme pullbacks or extreme snapbacks. I would be looking at for it to hit, the 21 EMA on the daily, chart initially, but then looking for, further confirmation that maybe it's going to roll over. So I hope that makes sense. Now, sometimes when you're too cautious, you miss the boat, but I think you have to kind of have a methodology in play, and you have to look at it and say, this is the area that I'm looking at. What is my entry criteria once it does that? So that's kind of the area that I'd be looking at there, the 95.64 level at this point in time, and then looking to see if it hits that level, what's my entry criteria? Do I want to just take a short at that level with a stop above there, or do I want to let it maybe even spike through and then try to catch it when it rolls back over and sell it on weakness? So some of the ways that you can do that is, let's say if you use a 60-minute chart, you can wait for it to hit that level, and then you can look at a 60-minute chart, the same type of chart, and look for it to roll back below its 21 period moving average and get short, using that as kind of a trigger chart. Or you can look at a 60-minute Darvis squeeze, wait for it to hit this level, and then wait for a 60-minute Darvis squeeze, to the short side as a trigger. So there's a number of different, entry techniques that you can look at, and not just say, okay, well, if it hits that level, bam, I'm short, because, you might even get some strength above that level. You have to kind of have some techniques that you use to, put your mind at ease, or to help you kind of hone your lower risk entries. Now, that's not always the case, but I think in these kind of extreme markets, it might make a little bit more sense. So I hope that helps. Okay, let's have a look at the currencies, and let's see what I think is really driving these markets. I think is obviously we've got the crisis in Europe. We've got the crisis in Europe, which I'm not a fundamentalist. I'm not going to get into detail, but, and I haven't been watching the news recently, so I haven't been keeping on top, of what exactly the situation is in Europe at this point in time. We had the potential failure of Greece and, Italy and Spain. But, barring any of the fundamental stuff, I think what's really driving the markets right now is the breakdance fight that's taking place between the dollar index and the euro. Okay, so let's start out with the dollar index. If we really think about this, I mean, you've got this is really, when the euro and the dollar were kind of not really moving and they were stuck in a range for a long time, we weren't really getting much movement. But now that the dollar has broken above and the above resistance, and the euro has basically failed the $1.30 level. That was the key level in the euro. It failed the $1.30 level. That's really where we started to see a real pickup in the markets and some real movement. So in my opinion, that's really what's driving the market right now. It's the breakdance fight between the euro breaking down and the dollar going higher. If you look at, crude oil, it's priced in US dollars. I mean, it's natural to see crude oil go lower as the US dollar goes higher. All commodities that are priced in US dollars will tend to go lower when you have strength in the dollar. So if you look at this, what we had is we've got some major strength, and we have a Darvis squeeze that broke out really from the weekly perspective, that just broke out in the dollar index. So this is pretty significant, and I mean, we've been seeing some significant moves even before. I'll take a look at the euro next, obviously, but looking at the dollar index, I mean, you've got a Darvis squeeze that just fired here. You've got blue Hakanashis. We broke this 81.78 level, and we closed at 82.40. And as you can see here, you see how it broke out, and it came back down, and it kind of tested the breakout level, but not really. it didn't even really come down and test the exact breakout level, and it got bought all the way back up to the highs. You see that? That is a sign of strength, in my opinion. That is a major sign of strength. It is extended, but it is strong. You can see here you're above the zero line on your MACD, and you can see here you've crossed to the high side. Okay, on your on the trend indicator, we're higher. So all cylinders are firing to the high side here on the dollar index on the weekly chart. So that's pretty significant. Now, if we look at the, if you follow a number of different methodologies that you may have studied in the past, I'm going to show you here. This is like this is basically like a cup pattern, like a William O'Neill Investors Business Daily style cup pattern. You can see here. Now, one of the things that you'll notice is that a lot of these weekly Darvis boxes, because I think the cup and handle pattern is based on weekly chart patterns, looking at the Darvis squeeze perspective on the weekly chart is really, I've drawn parallels in the past between the methodology and how it's very similar to the cup and handle pattern on the weekly chart. Now you can see here this cup pattern on this weekly chart. It coincides with my Darvis squeeze setup, and you can see the break above that cup. Now it's not a cup and handle pattern, it's a cup pattern without really the handle. So you can see here that this came back and tested the breakout point, and you would be looking at really quite a bit of strength in here. So I can draw the parallel that you could treat this as a cup pattern. It's definitely a Darvis squeeze pattern according to my traditional definition of what a Darvis squeeze is. But you can also look at this in terms of looking at targets from a number of perspectives. So the question is, are we going to get more strength in the US dollar? Well, it looks like it. I mean, it is extended. It's quite extended from its 21 EMA. But if you look at this here, you've got, let me just zoom out. Let me just zoom out a little bit and see where we have price resistance. Well, you've got some price resistance in and around this level here, right? I'm not sure if at this point in time if it's a major level, but you do have some price resistance in and around that level. But, after that, you're really looking at retesting these highs back here. So let's throw a couple of lines on the chart here because these are some potentially significant moves coming into play. Now I'll leave that one a little bit lower than the actual high. Let's do a new parallel. I'm not sure if this is a significant level at this point in time, this kind of minor spike high. So let's just kind of go back over here and look. So I think that is an achievable target around, what is that, 83. Well, I'll tell you what, why don't I just make it bigger? Okay. For some reason, this is taking its time. Let's put it at, let's say 83.56, I think that is. Yep, 83.56. And then we have a potential target of, wow, this is pretty lofty, but I mean, if we get some strength in here, it wouldn't be uncommon, to get in a crazy kind of overextension. 88.56. At this point in time, that's a pretty lofty target, but I mean, somewhere in between there, I think is achievable. I'm not sure why the Darvis squeeze indicator for the chart has not kind of fired off here and is showing us where those targets would be. But I think in the short term, 83.56 is achievable, and I think we probably will see that level hit. And potentially somewhere in between 84 and 88, that would bring us to 86, somewhere in and around the 86 level. So it looks like we're probably going to see some weakness in more weakness in the commodities and some strength in the dollar. At least that's what this chart is telling me. Now that said, let's have a look at the euro and see if that's kind of in alignment with our thoughts here and what these charts are telling us. Okay, let's have a look at the euro. We'll take a top-down approach from the weekly chart. Now we've been talking about this chart for a long time, and the $1.30 level, the $1.30 level being the key level right in here. So let's just let me mark up this chart a little bit. We had the $1.30 level where we've been talking about if it fails this level, we could see a movement down to, at the time we were talking about $1.2644 in the euro. Now we hit that target and we even actually exceeded that target. So if you look at this, we've been talking for a long time about this, so this is really nothing new. You can see now in hindsight this pattern of lower highs put into play. Okay, this pattern of lower highs, but normally what you want to see, this is not hindsight. This signal here fired. We've been talking about this $1.30 level for a long time, and when we actually had this follow through, this signal here, and some decisive action below the $1.30, there's really nothing to do except really get short the euro. Now the target here from the Darvas squeeze perspective, because we did have a Darvas squeeze in play here, this valid signal here is $1. The target here on a one-to-one basis, it hit that target. So this is a little bit tricky now. I know I just said that the dollar index looks like it's going a lot higher, and we could get some more downside. But when I look at something like this, like for example on the weekly chart of the euro, what this is telling me is that yeah, we could go lower, but I'd be very cautious here on the short side of the euro because we've already hit this weekly target. And this has been a substantial move. We said if it failed the $1.30, we had targets initially of a $1.2644, which was this major price support level here, these lows, but then we've actually exceeded those lows and we've traveled the width of this Darvas box. Once this target is hit, normally, especially on a weekly chart, once a target is hit, I'm usually looking for some support in there. And if you actually look closely, you can see $1.2508, which was the target. If you draw the line from here across, you can see that it hasn't. It really is finding support at this time, right at that target. So the question is, are we just going to blow through that target? Well, I'd be skeptical. I'd be looking for some kind of a retracement. That's normally what I'd be looking at. So you've got a little bit of conflict between the dollar index and what, like that looks strong and like a continuation. On the weekly chart, it looks like, wow, it's just going higher, the dollar index. But now we've hit targets on the weekly euro, which was the inverse of the dollar index. And I'm looking at that saying, well, would I want to get short the euro at this point in time? No, I wouldn't, because, the move is already done. The move is already done. You've already hit targets. I'd be expecting, if I wanted to get short, I'd be expecting some kind of a rally back into resistance somewhere maybe around here. Have the moving averages come down and come close to maybe that trend line or something. Look for some kind of confluence, some type of level to get short. Now, that said, the MACD is rolled over. This Darvas squeeze is still, even though the targets have been met, this is still early in the weekly squeeze. And you've got a little bit of divergence here too. If you look at this trending indicator, we've had a lower low in price, but we've had a higher high in the trending indicator. So you've got a bit of a divergence there, which is kind of telling me that, that's overdone and we should be looking at some upside. So at this point in time, even though the dollar index looks really good to the high side, the euro looks a little bit overdone. It's hit targets, and I think I'd be looking at the euro for a bounce in the euro. So that kind of conflict between those two chart time frames is it's a little bit of analysis paralysis. I don't really know what to do with that. I think if the dollar is showing strength and it looks like it wants to keep going higher, and the euro fails this $1.2508 level and just keeps going lower, there's really nothing you can do but go with it. But that said, I'd rather see this support hold and a retracement back into resistance in order to get short the euro. So, if the dollar goes lower, we should see higher prices in the stock market. So there's a lot of conflicting things going on here, and I think you really need to just kind of see how the price action unfolds and see which scenario makes the most sense in real live market conditions. Doing these videos, it's just really a snapshot. And when I see this kind of thing, let's say if we were right here in the euro, then I'd be saying, oh yeah, dollar index higher, euro lower, right into this target. But this is really cautionary to me. Okay, this is really cautionary to me. I don't really know at this point in time where I would give more importance to, let's say, the chart pattern on the dollar, or these targets being met on the euro. So this is kind of throwing a little bit of a wrench in my analysis here. Not sure at this point in time what to do with it. Just going to have to wait and see how the markets unfold next week. Now this could very well just fail this level and keep going lower. I mean, we could be experiencing extreme markets. In a normal market, I would expect this to hold and push higher. But if we're in extreme markets, we could hit 1.5 times, 2 times the width of this target. So I'm cognizant of that as well. So at this point in time, I think going into next week, I'm just going to be cautious and look to see how this kind of unfolds and what signals are presenting themselves and what price action is actually coming into play, because that's really going to tell the story in real live market conditions. I hope that makes sense. Okay, let's just kind of round it out by looking at the euro from the daily perspective. From the daily perspective, what I'm really looking at here is you had a Darvas squeeze form back here on the daily chart. Target was met more than twice. Actually, the width of the target was met. And at this point in time, we haven't really tested the 21 EMA in a long time. The 21 EMA is at about $1.2833. So the safe trade to me, in my opinion, would be to look at a retracement of the euro back into logical dynamic resistance, and around the $1.2833 level. Staying below the $1.30 level, because the $1.30 is really the key breakdown level. And if we got a retracement back into, let's say, $1.28 half, $1.2833, then I'd be looking at a potential short position. So I'd be looking at a potential short position, and I'd be looking for follow through back down to the downside at this point in time, because everything is in alignment at this point in time for downside on all chart time frames. But I think I think it's overdone, and I think you really need a decent retracement to really initiate a new short position. I wouldn't go long at these levels. I'd be really looking for, we were in a momentum type market with the Darvas squeeze on the weekly chart coming into play. So let me see if I can explain this so that it makes sense. Okay, because when you're recording these videos, you're not always sure that you're logically making sense. So the Darvas squeeze, for example, this is a momentum type of situation where this is kind of like a go with type situation where when it breaks, you see that it just goes 1 week, 2 weeks, 3 weeks, bang, 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 target hit, momentum type situation, go with type situation. Now, when you go from a momentum type situation, I always look at the markets from two perspectives. I look at it and say, by markets, I mean the markets I'm looking at any particular point in time. Now, are we in a momentum type situation, or are we into a reversion to the mean type situation? So are we momentum or are we RTM? So we were in a momentum market, but if we find support at these targets and we retrace back up here, we're going to be in a reversion to the mean type of market. So we're going to switch from what I assume was last week, the week before, the last several weeks, let's say the last 2 to 3 weeks, momentum situation, back to reversion to the mean situation. Now, in this instance, I'm using the, we're extended from the 21 EMA, which the 21 EMA is basically my mean or my average level. So returning back to the average, returning back to the mean is pretty normal. The market goes through extremes where it goes momentum, and then it's like, okay, we're so far extended from the average or the mean, it's time to return back to the mean. So I look at those as kind of, for lack of a better word, market modes or market phases or market behavioral patterns. So, basically going from momentum back to, going from momentum, which is really the Darvas squeeze type situation, back to reversion to the mean. which is really like retracement back to the 21 EMA type of situation. It's really quite normal. So at this point in time, I'd be looking for signs of strength back into, to enter into a reversion to the mean type market, and to look at, looking at initiating fresh shorts if we get back into these levels. So the other way I'd be looking at this is I would say, okay, here's an obvious high, right? Let's just mark this. Here is an obvious high. Here is well, it's not an obvious low yet, but if we get a signal where, let's say, we get price action above the high of these bars, and especially the high of this bar, then that would indicate that a swing low, okay, a swing low has been put into place. So what I'd be looking at here is, let's say if a swing low was put into place and we're going to get a retracement, then I'd be looking at, here's your high, here's your low. Let's throw some fibs on here and see where the 50% retracement is. So that would be, the fib players would be, the fib players would be looking at this as an obvious retracement level. Let me just see here. So we've got Fibonacci tools, price retracement lines. So let's grab it from the top of this box. Let's assume that this is a low. We don't really know that yet, but let's assume that's the low. Okay, so what I'd be looking at then is this kind of, I'd like to see this because I like this kind of confluence where you've got, here's your high, your low, 50% retracement. If as the price is moving back in here, this is going to bend the 21 period moving average slightly higher, because the 21 period moving average, or any moving average for that matter, is a dynamic level, and it's going to adjust as the price action adjusts. So looking at this, if you see this as a a move higher, you'd be looking at the 21 period moving average bending a little bit higher. So this is a nice looking level here between $1.28.33. Okay, the 50% retracements at $1.28.86. And then we were also saying maybe $1.28.5. It's not an exact science, right? It's a work in progress as you're seeing these levels being hit and as the market unfolds. So I'd be looking at, this as an initial short area, wherever, when the price action comes up, wherever it touches the 21 EMA, wherever the 21 EMA is at that point in time, I'd be looking at that. And then I'd be looking at this entire zone. If we close above the 61.8, which is at this point in time, let's just see here. At this point in time is around, if this ends up being a swing low, this is all predicated on the fact that this is a swing low. So $1.29.81. So if we get a close above there, which would bring us right to the $1.30 level, then it's probably not going to work. So what I'd be looking at, I don't think I'd want my stop that loose. It's not really a wide stop, but I think you'd really want to see, if you get some kind of retracement up here, you'd want to see it work out fairly quickly. It could possibly come back. I mean, if you want to be really cautious and give it room to work, you'd really need to keep your stop above the $1.30 breakdown point rather. But I think looking at it from this perspective, it would probably make sense to just, I'm looking for this kind of chart pattern to take place, and not necessarily looking for these low of targets, but I'm basically looking for, the first test of the 21. If it comes into confluence with these levels, I like the multitude of levels. I like the confluence of multiple levels, and then looking for it to come back down and retest these lows, and possibly, even if it holds those lows, you have enough air or enough room to make a profit in between this and a retest of these lows, even if these lows ultimately hold. Now, that's assuming that this is actually a swing low point. We don't know that yet at this point in time, but this is kind of the scenario that I'm looking for to play out. Now, the other scenario that could obviously play out is just, boom, a failure of this, and it's just like, those are the kind of moves that are the hardest to get on board, and the ones that I usually miss, because once something is overextended like that, I don't want to sell the low hoping it's going to go lower. So I hope that makes sense. Those are really your decision points, where you get a retracement back into here, stop somewhere up there, or even, or just, I mean, if you're feeling if you're feeling, I don't want to say lucky, but if you're feeling like that it's just going to go lower, is just going with it and maybe sell stopping just below the low of this bar, or even down, down here somewhere, and just sell stopping that if it's just going to collapse and go lower. So those are really your decision points. I think what would make more sense is scenario 1, reversion to the mean. But if that doesn't work, then your second decision point would just be, momentum, kind of sell stop below the low. So those are really the scenarios and the decision points that can be looked at. Okay, I just took a quick look at some of the other currencies. I'm not that interested in a lot of the other currencies. They all look like they're basically going lower. With the euro and against the US dollar. So the US dollar is kind of driving everything else lower. Now, I'm going to look at take a look at the Japanese yen, just because the Japanese yen looks interesting. Now, we've been talking about maybe trying to short the Japanese yen for a while, but I didn't really like the price action as it got towards this 21 EMA on the weekly chart. So let's just kind of re-review this and see if it makes sense at this point in time. You've got a little bit of conflict going on, but what I initially said was I didn't like the short side of the Japanese yen when it got down here because I thought it was overdone. I didn't like it shorting it here. I was initially wanting to short it around the 21 EMA, or looking at like it making sense shorting it around the 21 EMA. However, when it got close to those levels, I didn't really like it, and I've been talking about that in the videos for a while. I didn't really like it because I thought it was on the daily chart too strong, and I didn't really like the price action that was taking place there. So you have to look at setups within the context of what they're doing in terms of their price action at any given point in time. So looking at that, I didn't like it. I didn't like shorting it here. Initially, I did, going back into here, I said, well, if it hits the 21 EMA, that's a good area to initially look at getting short. When it got there, I decided I didn't really like it anymore, which, you're entitled to change your opinion at any time in the market, just as the market is entitled to change direction on you at any given time. So you have to take it with a grain of salt and take it for the context of what the price action is telling you at any given point in time. That said, we're now in this, from the high up here to the low down here, we're in this, basically in this, what some people like to call an ambush zone. You're in between the 50 and the 618% retracement from a fib perspective. And this is an interesting place to be because if you get above this area, obviously like we're going higher, right? If you get some decisive closes below this area here, $1.2533, and then below this $1.2481, then it looks like a potential resumption to the downside. That's really what I would expect to happen in terms of this pattern kind of playing out. If it breaks this level, it would make more sense to go lower. Now, here's a potential heads up that it might want to do that. Now, what I'd be looking at here, and this is one of the ways that I look at these markets where, on the weekly chart, I've explained the situation and I hope that makes sense. And on the daily chart, what I'm looking at here is we had signs of strength on the daily chart, right? And you can look at this from a number of perspectives. Like, for example, on the daily chart, you have this situation here where let's grab this low here and let's line it up with one of these lows and see if we can get a decent trend line. So I'm going from this first, what looks to me like the first swing point low, and that's giving me a decent looking trend line, okay? So when I look at that, I see, okay, once we broke above the 21 period EMA on the daily chart, we found support, and we've been structurally in an uptrend. We've been putting in a series of higher highs, right, and higher lows, right? Here's a higher high, higher low, higher high, higher low, higher high. But now what we're doing is we're kind of going sideways, okay? We're kind of going sideways, but what we're also doing is we're testing this trend line. So this is the obvious support level here. Okay, this is the obvious support level here with trendline support, 21 EMA support. But what I'm looking at here is if we, let's say, here's the higher high, right? If we, let's say, do one of these and we put in a lower high, and then we fail this trend line and we push below the 21 period moving average, I would be inclined to look at this as a situation that is potentially shortable. The reason why I say that is because the weekly chart would look as though we've had, you know, the down move, the initial down move, and then a substantial retracement back up. And in order to get that substantial retracement back up, we had to enter into an uptrend on the daily chart. So I hope that makes sense. Like here's your downtrend on your weekly chart, and then in order to get the retracement back up, you know, to let's say the 50% retracement, right? The daily chart had to enter into an uptrend, right? I mean, that makes sense. So it had to enter into an uptrend, but now the failure of this uptrend, okay, the failure of this uptrend would bode for a potential sell signal on the weekly chart as well. And what I mean by that is they would kind of come into alignment where, let's say, if this fails here, then what you could be looking at is a continuation on the weekly chart by taking the signal on the daily chart. So I hope that makes sense, right? So here's your daily, here's your weekly, right? So, you know, you've had this kind of, you're looking for sell side signals on your weekly chart. You've hit levels where you're sort of interested in getting short. Not sort of, you are. They're logical areas to get short. But then the daily chart kind of has to come into play. So what you're doing is you're kind of using the daily chart to drill down and to get an entry off the daily chart. So I hope that that logic makes sense. So keeping that in mind, what I'm looking at then is now you've got an uptrend here denoted by, you know, the stacking of these boxes higher, and also this uptrend, and the 21 period moving average is moving higher. So now what you're looking at here is a potential Darvas squeeze signal. So for example, what I'm looking for is if this Darvas squeeze fires short and we get a Darvas squeeze short. Okay, if we get a Darvas squeeze short at this point in time, signal firing, even though it's against this trend, I think that it would make sense to look at taking this signal because it would fail this trend line. Okay, it would also coincide with a failure of this trend line, right? Because it would fail the trend line there. And it would also be a fresh short signal, even if it's against the trend, because the weekly chart, would sort of be an alignment. So I hope that makes sense. So this is something that I also look at on lower time frames where you get, let's say, an uptrend and then it's not going any higher. It can't get above this high. So if it can't get above that high and you get a Darvas squeeze short signal, well, then it's probably going to go lower, right? I mean, it sounds rudimentary, but it is often true. And what I'd be looking at there is this is a major support level here at this point in time. The failure of this with a Darvas squeeze short, I'd be looking at, okay, take a picture of this in your mind. If we get a Darvas squeeze short here, okay, take a picture of that, and then let me flip over to the weekly chart. So that would be kind of a continuation of this kind of setup here where you get a failure of the 50% zone. It doesn't get above the 61.8, and then what you're looking at is a continuation lower here. Now, the thing that you have to be careful of here is if ultimately it is going to go higher, it might do one of these, put in a swing low, and then push higher. So this, I think logically, you need to look at these highs or the 61.8 as your stop out point. Okay, if this scenario plays through. Now, if this scenario does not play through, if it doesn't follow through, right, like I'd be looking at, let me just back up here. I'd be looking at this kind of scenario to kind of follow through if I got a Darvas squeeze, if I had a Darvas squeeze short on the daily chart, okay? And I may be over-explaining this, and if I am, I apologize. But I think this is a decent opportunity to to look at, how you can analyze the markets from different perspectives and look for signals where you may not see signals by using multiple time frames and using signals off of different time frame charts and key levels off of higher time frame charts. So again, I hope that makes sense. So a Darvis squeeze short on the daily chart with a failure of these levels here, a stop above the high here or above this level here would make sense, okay? With a potential target of, half the range here. So what I'm looking at here is if this ultimately goes higher, it's probably going to put in a swing low if it does go higher somewhere around here. In other words, a 50% retracement of this low to this high. So I'd be looking to take some targets, some profits somewhere in and around that area. And if it does come down here, I'd be looking to lock in my profit. I'd be looking to trail down my profit here so that I don't get taken out of the move and ultimately stopped out. So in other words here, if this follows through, Darvis squeeze short on the daily, initial stop, take target somewhere down here, and then I'd be looking to, once I took some targets, some profit targets, I would lock in my additional targets either at entry or at within, so that the entry or so that my stop was in the money. Like my target, if I got stopped out, it would be stopped out at a profit. So I hope that makes sense. Let's just switch over to the daily chart again. Okay, switch over to the daily chart again, and I'd also be looking at potential targets. I'd be looking at potential targets on a 1-to-1 risk to reward ratio if this scenario follows through. Okay, like if this scenario fires and it follows through. So I'd be looking at, okay, where's the Darvis squeeze short target, and looking at the weekly chart, where are the potential targets. Now, if this actually holds, if this level holds, right, let me just change the pen color. If this level ultimately holds and we actually get a Darvis squeeze, right? Darvis squeeze long. Well, then I think that in itself would be a potentially valid signal too. Now you obviously have resistance in here, right? But this would, if it fired a Darvis squeeze long, you could either step aside and leave it alone, or you could look at, doing the same thing where you're just looking at, okay, we're in an uptrend on the daily chart, so I'm going to take this as a long trade with my target somewhere up here, my 1-to-1 risk to reward ratio. And placing your stop, just below either this swing point or below the trend line. Okay, and even trailing it up below the trend line so that you don't, really take a big hit if it reverses. So I hope that makes sense. In other words, you're really in a dead zone here, and whichever way the Darvis squeeze fires is a potential valid signal and is a potential valid trade. So here's your dead zone. And then here is your, your potential decision point areas above and below, that Darvis squeeze setup, whichever way it decides to fire. Hope that makes sense. Okay, let's, I'm not going to say a quick look, but let's take a look at the gold futures. We're already an hour and 20 minutes into this video, and I apologize for the length of this video. It's just, we haven't looked at the markets in from a video perspective in like 2 weeks, and I haven't actually reviewed the markets fully, other than the markets that I actively trade in just over a week. So let's have a look at the gold from the weekly chart. The weekly chart looks weak, but we have support coming in here. I mean, we've been selling off here, right? But we have support coming in here around 1545. Okay, and it looks like we hit those targets. We slipped a little bit below, but we're holding above the 1545. Now, you can see this support level coming into play on the weekly chart at a number of levels here, right? And now here again. So this is support. If we fail this 1545 level, well, you've got some potential targets here. You've got some potential targets here. I don't know if that's really a reasonable target. Where this fired way back in here. But I'd probably be looking at, extending this box down somewhere down here, on a 1-to-1 ratio. So, We don't have a valid Darvis squeeze, but if we did, let's say, fail that level, I'd be looking for at least another 100 points of downside to come into some of these, maybe these longer term support levels. So we'll have to reevaluate where those potential targets might be. I'm not really at this point in time actually that interested in the downside because I think we've come a long way down, and I think it might make sense to to look at, for example, some instead of being in momentum mode, going back to reversion to the mean mode as we discussed earlier, and looking at, like, for example, this target here. We had a Darvis squeeze short signal here around 1612. We hit the target at 1544. We found initial support close to where the target was, right? And now this is looking, I always treat this as a dead zone, okay? This is really the dead zone here, this new Darvis box forming. But what I'm looking at here is this is potentially a higher low being put in place. So I'd want to watch that and see if we're going to break above this high, or if we're at least going to come up and retest, the logical resistance, which is going to be at the 21 EMA or somewhere around where this kind of sloppy trend line is, somewhere up in this region here. So at this point in time, I think the easy move of looking at, gold short is done. And at this point in time, I'd probably be looking at some retracements back up into logical resistance. Okay, let's take a look at silver. To me, silver looks the same. If I look at the weekly chart, it came down close to these lows, somewhere in here, and you can see that that it was accumulated up, closed more than 50% off of its lows. So it looks like some at least short-term support is coming in. It's still net looking very weak, but there's some short-term support on the weekly chart that looks like it's coming into play. And then if I look at the daily chart, which is really sloppy when it's this far out, so let me just kind of expand it in. The daily chart to me looks kind of the same as what as the situation in gold, and by that what I mean is, now you've got a Darvis box forming. What I'd like to see is maybe a Darvis squeeze set up and see which way that signal is going to fire. If we have a Darvis squeeze signal to the short side, then I don't think you could really fight that. But at this point in time, to me, this looks like a swing point low. To me, this looks like a higher low being put into place. And what I'd really need to see in order to confirm that, obviously, is a break above this swing point high. Okay, a break above this swing high. So at this point in time, it looks to me like the decline in silver has been halted, and now we're just in this range, this dead zone, and I'm looking to see if we're actually going to get a reversal, or at least test this 21 EMA resistance level, test this potential trend line, and look to see maybe if we can get a Darvis squeeze and get direction outside of this range to see which way we're going to go. Okay, so outside of the dead zone of the Darvis box range, hopefully get a Darvis squeeze and see which way it really wants to play out. Now, if we enter into an extended period of sideways action within this Darvis box, then to me that'll just be kind of like either an intraday or a day trader's market, and looking for the intraday trends within that range, or just from a swing point perspective, just leaving it alone, basically. Okay, I'm just going to jump back to currencies, and I'm going to take a look at the euro cable, or the euro British pound in the forex market. I'm going to take a look at it for Galina, who is a soon-to-be trading floor member of ours. We look forward to to having you on board. So I'm going to take a look at this from the kind of the perspectives that I look at. So net, the euro pound looks down, and we had a Darvis squeeze short fire here, and the target was met on the weekly chart. So what I'm looking at here is, here was the Darvis box that was in play at the time. We had a short signal fire, and then we had a target that was actually, let's see here, the target was met, and it actually exceeded the target a little bit around the, let's see, 80, geez, it's hard to read, but I think it's 80.30. So when I look at that, and then you can see some support coming in. Now this is on the weekly chart. So from my perspective, that trade from the weekly basis is basically done. If you were taking this signal off the weekly chart, you hit your full targets, and I think the move is done. So from the weekly perspective, I wouldn't be looking. I wouldn't really be looking for more. Really for much more downside. Now anything can happen in these markets, but looking at the euro and maybe some potential retracements in the euro, I think I'd really watch the euro closely to see if it's going to bleed through the targets that it met, and if it's going to enter back into retracement. Now if the euro goes higher, then then you're going to you're going to see this currency pair, go higher. So if you're short this, strength in the euro is going to, I hope I'm saying this correctly, strength in the euro is going to work against you. So at this point in time, I'm cautious to the downside on the euro. I think it's already hit its targets. So I'd be looking at this from that perspective and saying, okay, if we start getting some significant strength in the euro, I would want to maybe look at locking in some profits, or at least managing my risk so it doesn't come all the way back and I turn like a winner into a loser. So I'd be looking at it from that perspective at this point in time, because it's good to ride out trades, but you don't want to really give back all your profits. So you have to, at this point in time, it's really, from my perspective, a trade management issue where you have to keep those considerations in mind. So let's have a look at it from the daily perspective. From the daily perspective, it's in an obvious downtrend, and you can draw a trend line here. Let me just see. A trend line from this high, connect some of these highs in here. And that doesn't really help us much. But what I'd be looking at, that doesn't really help us a lot from this perspective. But what I'd be looking at here is we have come a long way. It's no different than the analysis on the weekly chart. We've come a long way, and we had a logical retest of resistance. I think we discussed this when I was here last week, where we were getting at one point in time we were getting some strength, and I think what we were talking about was this was a logical. This market had gone down for a long time, and this was a logical test of resistance. So it's not uncommon for a market, when it's been going down for a long period of time, to come back up and to retest the 21 EMA. So this was just a retracement back into logical resistance, right? So now what we're looking at is it failed that resistance, which is what you're expecting, right? There was a failure of the resistance, so that's good for the short side. But at this point in time, now you've got a Darvis box in play, and what I'd actually be concerned about at this point in time is I'd be concerned that maybe the move is done and that this is looking to put in a higher low at this point in time. Now, you don't really know if it's going to be doing that. Where you do know that that's going to happen is, and this is why I'm saying this is really a trade management issue, is if you're in, let's say if you entered the position here, okay, let's say you had a fresh short here, right? So you had a fresh short here and it starts working out for you. At this point in time, I'd be looking to trail down my profits and lock in some profits, because what you don't want to have happen is it do one of these, put in a higher low, and then break through this swing high, okay, and break through this Darvis box. So what I'd be actually looking at is I would have, if I really wanted to stay in this trade and give it some room, I would place my stop above this swing high. This is what I would do. I'd place my stop above that swing high. And if it's going to continue down to the downside and you're going to stay short, that's great. But if it's not going to continue short, you manage your risk. Now, no trend persists forever. This trend has been in play for quite a while, and there's been obviously a good move out of it. But at this point in time, if you get a break above this Darvis box here, that to me is a reversal signal. Okay. Now, let's say if you stay with this trade and you're trailing your stops down and this breaks below the Darvis box, then I would say stay on the short side. Because if it breaks below that Darvis box there, especially if you get like a squeeze come into play, and then you get a Darvis squeeze short. Okay, you get a fresh Darvis squeeze short, then there's going to be more room to the downside. But I'm personally, and this is just my own bias, my own personal bias, I'm cautious on the downside of this because I think that the euro has in the short term potentially. It's come a long way, and I think it now is probably ready to do some retracement back to the high side, the euro. So, I mean, we don't know if that's going to happen, but at this point in time, I'm looking at this saying, this is a potential higher low being put into place. I wouldn't really want to see it, break this kind of trend line here. You know what I mean? If the price action broke that kind of a trend line, then I'd be really cautious. But at this point in time, you don't have any fresh signals. It really becomes a trade management issue where you don't really want to give back profits. So I would be looking at, like I said earlier, either placing a stop above here if you're in the profit, or even trailing it down and placing your stop above the high of that candle. Okay, the high of that candle, because that is technically a key reversal down in a downtrend. That in itself is a sell signal. Okay, this key reversal down. But if it fails this key reversal down, then I think the move is potentially over as well. So, I mean, from a trade management perspective, that's where I'd probably, if I wanted to be conservative, I would place my stop above this candle, which I guess took place on Thursday, the high of the daily candle on Thursday. If I wanted to be less conservative, more aggressive, give it more room, I would place it above this high here. Okay, that swing point high. So I hope that makes sense. From a trading perspective, it really, you don't want to see it close above the 21 EMA really. Here it did one day and then it reversed back down and you had a key reversal down. Here you have a key reversal down. I don't think I'd really want to see it. I really wouldn't want to see it above there at this point in time. I'd want to see if it's going to follow through, just do one of these and break through. So I hope that makes sense. We can discuss that more in the trading room as the real-time market develops. I'll see you and I'll see the other members of the trading room tomorrow, Monday morning, back in the office, back in action, and we'll kind of pick up from there and see where this market and where the real-time action kind of unfolds and where things go. But at this point in time, I think I'm cautious to the downside on the euro. That being said, I mean, we could enter into an extreme market situation where we get more downside. But I think what makes more sense from an orderly market perspective is to see some retracement higher in the euro next week. So, anything can change. It's just an opinion right now. But anything can change as the market develops. So I'm cognizant of that, and I will be cautious and let the price action tell me where things can go. I'm not married to either side of the position in terms of do I think the euro is going higher or lower. I think the euro is going to go a little bit higher, even though it's net short side, looking for some retracement. But anything can happen. So it's important to keep an open mind and let the price action tell you where things are going to go instead of being too rigid in the analysis there. Hope that makes sense. Okay, I'm going to wrap up this video with a look at the grains. I'm going to look at corn first. Corn to me just looks sloppy sideways. You've got a Darvis squeeze forming. Not sure which way it's going to fire off, but at this point in time, what I'd be looking at is just following the signals wherever they take me. If it fires off short, be looking at the short side. If it fires off to the high side, I'd be looking at the high side. So that's corn. You can see here on the daily chart. On the daily chart, it's really sloppy. What do you do with that? So I'd be looking for direction out of that Darvis box, out of that Darvis squeeze on the weekly chart. It's really a wide box here on the weekly chart. It's a really wide box. I'm going to actually just draw a couple of lines here just so that we can see how wide it is on the corn. Okay, so let's see, 649 7/8, new parallel, and let's see, 653. So I mean it's a fairly, well, 649, 653. I guess it 653. I guess it's not that awfully wide, but it is a pretty sloppy, choppy range. So I'd be looking for some direction out of that range in order to long above, short below, and I would just treat it this as the dead zone. So that's kind of how I'm looking at that. Taking a look at the let's take a look at the soybeans. The soybeans. We were in a pretty major uptrend on the soybeans, and we hit that resistance that we were talking about the other week. And then now we've come back down. Here's the weekly chart. We've come back down and we found some support at the 21 EMA on the whoops. Let me just here. Let's expand this out so it makes more sense. So here's the weekly chart. We hit the resistance up here. We sold off. I think at the time, if memory serves me, and I could be wrong, but if memory serves me, I think we were looking for lower prices in the grains because I felt that we had hit the resistance and a logical pullback made sense. So this is the logical pullback on the weekly chart to the 21 EMA. You were in an uptrend. You came back down. You pulled back. So this is a logical technical pullback. At this point in time, you're between the 8-period exponential moving average and the 20 EMA. So at this point in time, I really don't have an opinion on it, except to say that I really wouldn't do anything with it except for maybe on an intraday basis at this point in time. You really need to break above this in order to get anything going. But I really don't have anything on this at this point in time. So let's take a look at the daily chart and see if that's telling us anything different. Not really. The daily chart has gone negative. We're below the 21 period moving average. You have here's the obvious stuff, right? You have an 821 crossover. Now you're putting in a series of lower highs. Right? You've got lower high here, lower lows. So now you're entering into, you had this major uptrend. Now you've got the crossover. You've got, the first pullback could have been a short entry. Once you confirm that you were going lower, this could have been this lower high level. The 21 period exponential moving average could have been an initial short entry, even though at the time it was against the trend. But, the trend was obviously looking like it wanted to cross over, right? But at this point in time, you're in a minor downtrend, and until you break above the 21 exponential moving average, I think that all retracements back into the 21 period moving average are shortable, with relatively cautious stops. Because here's really, if you really look at this, let me just kind of zoom this out. If you really look at this, this is your major uptrend. Oops. Your major uptrend was in play, and now you're in a minor downtrend. So looking at your major uptrend from either one of these swing points, I think this swing point probably makes more sense. Let's take a look at Fibonacci tools, price retracements. Let's say here's your low, okay, for your major uptrend. Here's your high. So you could get a move all the way into a 50% retracement, which would take you to 1335, all the way down to 1294. So I think that a move down into 1335 makes a lot of sense. The tricky part will be finding a decent entry. If it came back up here and it hit the 21 EMA, I think it makes sense to potentially take a short there with a stop above, let's say, that swing point. So let's say this would be your stop. And again, this is what I'd be kind of looking at doing. This is not specific trade advice. But I'd be looking at maybe a stop above there, an initial short entry at the 21, right? Somewhere around the 21, and I'd be looking at a target around this area here from a swing trading basis. And if we fail that level, I'd be looking at this. Initially, this would be support until the 1294 failed. So that's kind of like, here's your major uptrend, here's your minor downtrend, and maybe looking at a situation like that, you know, or looking for a situation where you're going to probably get a move back down into this level and maybe taking a short-term short down into these targets. So I hope that makes sense. I think the pressure on the daily chart is to the downside. I mean, your MACD is crossing below the zero line, and now you're getting some weakness in here. This could reverse at any time, but I think, you know, you've got, let's see, one test, two tests. I think you probably get, like, sometimes I look at the market this way too, and here's a little kind of a tidbit or a secret of some of the stuff that I look at. Not that it's a huge secret or anything, but I mean, usually what I'd be looking at here, like, let's see if this holds true on the upside. I'm not sure if you could count this as a test of the 21 period moving average, but let's say you do. In here, you've got 1, 2, 3, 4. If you don't count this one, you've got 1, 2, 3 tests of the 21, and then it failed. So sometimes I look at that 3 count, the 3 count test of the 21 period moving average. You know, sometimes it's 3, sometimes it's 5. So when I start getting into 3, I get cautious. So what I'm looking at here is you get, let's say, I'm not sure if this would be a 1 count, but this could technically be a 1. Or if you don't count this one, this could be your 1. Count this as a 2 or your 3rd. I'd probably be looking at one more test of the 21 period moving average, and then I'd be very cautious. So let's say this is 1, and this would be your 2nd test. I'd probably be willing to take that, right? If it came back up and it tested it the 3rd time, I'd be more cautious. I'd be more cautious there. Excuse me. So I hope that makes sense. I'd be looking at this, let's say this test, with a relatively decent stop, and for a move down here as a higher probability trade. Once you start getting, you know, 3 or more tests of the 21 period moving average in the direction of, you know, your major trend or your minor trend, you know, this being your major, this being your minor, I think you have to start looking at that and saying, okay, you know what, we've had 3 tests and it might break through. It's kind of like if you watch Rob Hoffman, who I've been following, you know, for about a year and a half. I follow some of his work. I don't do exactly what he does in trading, because I think that as a trader you have to kind of find, you know, you find what works, but you have to trade within your personality, and you have to trade, you have to learn, and then you have to make it your own. So I'm not a shadow trader. I'm an independent thinker in terms of the trade setups that I do, and I kind of learn from other traders. I make it my own, and I kind of roll with that. But one of the things that he talks about is, let's say you have a support level and you get a skipping rock. You know, when you throw a rock as a kid along the water and it hits it once, hits it twice, hits it 3 times, it starts to lose market energy, and then it'll just slip below that level. Well, I've kind of, recognizing that that's a really good concept, his skipping rock theory, I kind of also look at, skipping setup theory. And what I mean by that is just based on my observation of how the market kind of moves in waves, and how the market, no trend persists forever. One of the things that I've noticed, for example, is that you get a situation where, the market might enter into a trending situation, and then you get kind of skipping setup theory. So let's say here's your reversion to the mean type setup, and you get here's your kind of signal when the 8 crosses below the 21. So you could actually say that your first retest is after the 821 crossover. So here would be number 1. So number 2 is a higher probability, but once you get into 3 to 5, I think at that point you have to look at that and say, this is not as high probability. So this is kind of like a skipping setup theory that I've developed. Nobody really talks about this, at least that I've come across. The closest has been, Rob talks about a skipping rock theory, where it does this at a support or resistance level. But one of the things that I look at is kind of skipping setup theory, where, you get, no trend persists forever. So you get, 1, 2, 3, boom, failure. So that is something that I look at from a macro, reversion to the mean, let's say setup level, where I'm looking at so many tests of a moving average, and then after that I'm looking at it as lower probability. So I hope that makes sense. I wanted to share that concept. It's something that I haven't really I've talked about with some of the members of the trading floor, but I haven't really talked about that on the videos. But that is an observation that I've made over time, and one of the things that I look at, or that I've come to realize, is a real situation where you might get so many tests of the 21 period moving average, and then it's just no trend persists forever, and it's just going to stop working out, or it's just going to fail, and you're going to get a reversal. So that's one of the things that I'm looking at here, and I think that from this perspective, the next test of the 21 period moving average, you can even draw a trend line here and see if you get confluence between those levels. I think that would hold, and then I think after that I'd be very cautious, and I'd be looking at a target somewhere in here. So to make a long explanation short, I like the short side of the beans on a decent retracement back up to the 21 EMA or to trend line resistance, whichever level kind of makes sense. So I think everything's kind of coming into play to support that, and I think that makes sense, and I think that the soybeans have been trending a lot better than the other, the corn and the wheat. So given the opportunity to trade any of these, it would definitely be the soybeans. And I think I'd leave those other markets alone right now because they're really difficult to trade. Let's just take a look at the wheat. The wheat probably looks a lot like corn. I haven't looked at it yet. But let's see here. Yeah, it's just really sloppy. I mean, to me, these look like potential limit moves. This could have been a limit day where you just, you don't want to get stuck in one of these limit moves. You don't really have a decent trend in place, although this looks like it's trying to kind of form a trend. But I mean, I really wouldn't know what to do with this. I would just leave this alone at this point in time until something, started to make a little bit more sense. I mean, if you look at this, you've got this huge resistance level or zone in here, and really on this day it just popped above it and it came below it. In order to really get anything actionable in wheat on the high side, you really need to close above this level here, which you can see is this has been an area of contention for a while. You really need to close above this level decisively, come back, maybe retest it, and then kick off again for some upside movement. But then right above that in the wheat, you've got this resistance level coming into play, not far above it. You've got you've got somewhere in here, between here and here. So I mean, we came up and we tested this level once. So really, I mean, you'd probably want to get above some of these in order to really be safe. And tradable above some of these levels, because you don't really have a lot of distance in between those. You don't have a lot of room to make a profit at this point in time. I think this market is just sideways. I would really just leave it alone until further evidence shows otherwise, or something else develops where it looks like it's an attractive market to trade. So that said, we're at a minute and 40, almost a minute and 48. An hour and 48 minutes rather. And this is a really long video. I might have just set a world record for my longest video. Apologize for that, but I've been away from the markets for a while. So let's wrap up this video. We have a meetup coming up. Next Sunday at the Market Trading Concepts offices. Looking forward to seeing you all there. The admission is $10. It's going to be an hour presentation and an hour of networking, technical analysis and chart reading, part 3. In order to link over to the meetup, what you can do is come to this site here, meetup.com/Burlington-investment meetup. Did I say that right? Anyways, here's the site here. It's been a long video. It's been a long week of travel for me. I'm back in the offices now. I'm back in the, I'll be back to trading next week. Mostly doing intraday trading right now. What I'm looking at here is We'll have the presentation on Sunday, June the 3rd at 11 a.m. It'll go to about 1, maximum 2 p.m. We'll be doing the presentation for 1 hour or just over 1 hour, and then 1 hour of networking. I'll answer any questions. There'll be a lot of back and forth. You'll have a chance to meet probably some of the other trading floor members at Market Trading Concepts if you have any questions for them, or just to get out and network with other traders. We're always at home in front of our screens, so it's a good opportunity once a month to get out and to to talk one-on-one or in a group setting with other traders. So look forward to meeting you all out there. We have 16 people attending right now that have signed up. Now that doesn't mean they're all going to attend. Some people change their mind. We have 2 spots left. If there are no spots left, you can still register and be on the waiting list, and it will automatically notify you if a spot opens. Now, if you're really adamant on coming and a spot doesn't open, you can contact me through this link here. Let's see. If you look at the members, investors and traders, you can send me an email here by clicking on this link right through the meetup site and just request coming, and I'll see if I can fit you in a slot if we are totally booked. So in order to join this meetup site, I'm logged in right now, but what you really need to do is you need to come to the site, and there will be a join us link here, and you need to click that link, and you need to opt into our group. You may also need to sign up for the meetup.com site and set yourself up a user profile, and then you need to opt into our specific group because there's thousands of meetup groups for different areas of interest on meetup.com, and if you sign up to our specific group, then you'll become part of the group. We have at this site 59 members. We also run another meetup group with another 60 or so members. So we have a decent group of people that usually attend the meetups, and we look forward to seeing whoever and everyone that can make it up at the next meetup next Sunday, June the 3rd. So any questions, you can send me an email through the site here, or you can contact me at dave@markettradingconcepts.com. So I look forward to hearing from you all, and I'll look forward to seeing you at the meetup that is coming up next Sunday. Thanks, and have a great trading week. Good trading. Take care.